Well, hello everyone, welcome back. This video is about the tax differences between the various forms of income. And just as a reminder, at this point in the video series, if you've watched it straight through, we've covered and talked about earned income. We've talked about portfolio income, and we've talked about passive income as the three types of income. And again, any kind of income that you could possibly think of will fall into one of these three categories, or either earned income, portfolio income, or passive income. So this video is really about just really understanding not the details. This is a fairly high-level discussion. We're going to cover some of these issues in a little bit more detail in some of the video blog videos that will be posted later. But the purpose of this video is really to describe the main differences between the three forms of income when it comes to taxes, mostly so that you can see why earned income is really the worst way to make money, and why portfolio and passive income offer some tax planning advantages and some tax benefits that earned income doesn't. So let's just start with a couple of basic examples, and I mean that'll pretty much cover it for this video. But so for earned income, it's pretty simple. If you make $100 from an employer, what happens when you get paid? Well, before you get paid, that employer already withholds taxes from your paycheck, right? So let's just say you're at a 25% tax bracket, and all your taxes together are total 25%, so that's $25. So before you even get your money, you're down $25, and all you get is $75, right? So here's taxes. Now with the $75, that's your take-home pay, right? That's what people refer to as their take-home pay. From there, you can pay your expenses, and you can find savings and investment from there, right? So let's say if your expenses and your saving investment, your total $75, then you're going to have zero left over down here. So again, just as a quick starting point, earned income, you start with what your gross. I mean, let's just say that you make $10 an hour and you worked 10 hours during this period. So there's your $100. 10 hours times 10 bucks. Okay. So before you even got paid, out come the taxes. Then your take-home pay is $75. You pay your own expenses. So this is where you pay your rent and your car payment and your mortgage and your utilities and your buy clothes and everything else. This is what you take for savings and investment, and that leaves you with zero. So let's turn our attention to portfolio income next. So portfolio income, again, is the type of income that's normally associated with certain investments, if you will. So if you buy stocks or bonds or mutual funds, income that you get both in the form of capital gains, if you sell something, but also in the form of just income for for dividends, interest, that kind of thing. So those are the two big categories of income through portfolio income. So, but let's walk through an example. So suppose you purchase a share of Coca-Cola for $50, right? $50, you purchase a share of Coke, and you also purchase a share of Pepsi for $50. Let's say you hold on to them for 2 years, so it's going to be a capital gains when you sell because you held on to them for more than a year. And let's say that after 2 years, that Coke share has increased in value to $60. But let's also say that Pepsi had a little bit of trouble, and the Pepsi is now trading only at $45 a share, a little bit lower than what you paid for it. Okay, so notice that up until now there have been no tax consequences. You've held on to these securities for 2 years. You haven't sold them. They've just been sitting in your brokerage account at Charles Schwab or where you have a brokerage account. And that $50 stock went to 51 and to 52, and maybe went back down to 48, and now it's at 60, right? So, but the Pepsi shares have gone from 50 down to 45, and so. But so far, this is all what we call unrealized, right? So up until now, this is just unrealized gains or losses. Okay, which makes sense because you haven't realized them. You haven't actually sold the stock to actually realize and have that money right in your pocket, right? That's what unrealized means. Okay, but when you sell, so I'm just going to draw a line right here, and we're going to call this, when you sell those shares of stock, that's exactly what triggers a potential tax. So let's go through that. When you sell the Coke shares, you have a gain of $10, right? You bought them for 50, you sold them for 60, it's a $10 gain. When you sell your Pepsi shares, you have a $5 loss. Right? You bought them for 50, you sell them for 45, you're down $5. So when figuring your taxes on your portfolio gains and losses, you're able to actually combine these together. Okay? So the $10 gain and the $5 loss ends up with a total gain of just $5. Right? So that's really important because if you had to treat these things separately, you'd have to pay the full tax amount on this $10, and then it'd be kind of unclear what to do with this $5. It wouldn't be worth it wouldn't be worth anything. So what you're able to do with portfolio income is really offset all your gains against all your losses, and and have a net number, which will, especially if you have losses, will allow you to pay a lower tax. Now notice also that losses from portfolio income can be offset against active income. All right, well, active income is what we call earned income over here. So if you have a job, which we talked about up here, so let's reformulate this a little bit and say your income over here is $100 minus what you've paid in taxes is $75, right? So you've paid this $25 in taxes. Let's, just to make this a little bit more interesting, let's actually say that we lost $10 on Coke and that we lost $5 on Pepsi, so that our loss here was $15, just to make this little point, this little side point here. So if our loss over here on the portfolio side was $15 and we paid taxes over here of $25, we can actually deduct this $15 against this $25 and really improve our situation on earned income. So it is possible to take that $25 of taxes that we paid and really get a benefit from this $15 of portfolio loss, so that our tax over on this side when we file our tax return is only $10. And so there is some tax benefit for generating a portfolio loss. So that's nice, right? Except that when you're talking about making money in life, you don't want to just continually generate losses in order just to reduce your tax burden. So that's kind of it's good when it happens, but it's not a long-term money-making strategy. But I just wanted to make sure that you saw how that worked. So now finally, let's talk about passive income. And let's use an example. Let's suppose that you have a buy a vending route. Maybe it's gumball machines in pro shops at golf courses or something like that. And suppose you employ a friend to manage the route for you, so you're really not doing the work yourself. So before we get into it, just as a highlight, you can subtract expenses such as the cost of that person and all the other things that go into it before you start paying your tax. So let's say you've got income of $10,000 on this route. Okay, but let's say all of your expenses total $8,000. And out of these expenses, this is going to be the salary that you pay your friend to manage it, the cost of goods. So if it's a gumball route, it's a cost of gumballs to put them in there. Maybe you have to pay insurance. Maybe as the owner, you're taking owner's salary. All right, owner's salary can come out of this $8,000. Maybe it's providing a part of a car for you as part of your as part of your package. Whatever other legitimate business expenses can go against this vending route can be deducted from the revenue before we calculate what's really our income before taxes, right? So we're able to again subtract all of these costs of doing business, which include paying yourself, even if you're not active in the business, you can still take compensation as the owner. This leaves you with $2,000. And so then after that, now we're going to take taxes off. Right? So you'll notice the difference here. Here we're taking taxes against the net income, the revenue minus the expenses. So the taxes are on a much lower dollar amount over here. Over here on earned income, the taxes come on the biggest number, right? Not here in passive income, but here in earned income, right? The top number. So you can see the difference. Earned income is taxed on your gross revenue. You get no opportunity to deduct any expenses before paying taxes. The only ones that are pretty common right now, mortgage interest, you can deduct. Charitable giving, you can deduct, and then depending on your income level, other things like student loan interest and things like that. But those phase out. I mean, they all phase out at some point, but charitable giving really doesn't. But everything else tends to phase out. So very, very minimal opportunities over here. Lots of opportunities over here to deduct legitimate business expenses from this passive income to really lower your taxes. So hopefully this quick video you can see earned income is the worst form of income when it comes to taxes. Passive and portfolio income give you the opportunity to, in the case of portfolio income, you can kind of really combine gains and losses, so you can minimize your tax burden. And with passive income, you can deduct the expenses that go into creating that passive income, so that your tax obligation is on a much lower number. Okay, that's it for this video. Thank you very much. We'll see you in the next one.